Hello everyone, welcome to Module 10. Today we are going to learn about feasibility and sensitivity analysis. Feasibility study is a research on a business plan that not only analyzes whether a business is feasible or not, but also when it is operated regularly in order to achieve maximum profit for a specified time, according to Matt in 2005. And according to Kasper and Jafar in 2003, is an activity that studies about a business that was to be run in order to determine whether the business is feasible or not. The results of the feasibility study report of a business will have a usual benefits for several parties, including investor, company management, economic development goals, creditors, and last is government and society. The purpose of feasibility study. There are five objectives of the need to conduct a feasibility study according to Kasman and Jafar. They are first, avoid the risk of loss. Second, simplify planning. Third, facilitate the implementation of work. Fourth, supervision. And fifth, controlling. Stages of feasibility study. There are several stages of the study according to Umar. They are discovery ideas, research data, evaluation, provide recommendations, implementation planning, and last is implementation. And here is the aspect of feasibility study. Sensitivity analysis is an analysis conducted to determine the impact of changes in production parameters on changes in production system performance in generating profits. The indicators of feasibility are determined by the value of net present value, internal rate of return, and benefit cost ratio. And here is the first quiz. What is the last stage of feasibility analysis? The purpose of sensitivity analysis. Sensitivity analysis is a method of measuring the feasibility of a project. This analysis is only a tool to test the sensitivity of net present value and internal rate of return calculations if one assumption changes while the other assumptions are considered constant, according to Kashmir in 2010. The weakness of sensitivity analysis is that if the decision maker accidentally makes an estimation error on one of the variables, it can result in an error in decision making. And now is the calculate indicators on financial aspect. Net present value. Net present value is used to determine the present equivalent value of future fund flows from a project investment plan. And here is the meaning of net present value calculation for investment decision that will be made. And there are three conditions. And last, for net present value is the formula for net present value. Payback period. According to Ferris, payback period is the period of time required to recoup the fund expended in an investment. And here is the formula for payback period and with the notes. Next is internal rate of return. According to Hyrule de Jackman, internal rate of return is the capital interest rate that reflects the level of control that balances the current input value with the current output. A project will be considered feasible if the internal rate of return value is greater than the minimum attractive rate of return. And here is the formula for internal rate of return. And here is the requirements for internal rate of returns. There are two requirements or two conditions for internal rate of return. Next is benefit cost ratio. Benefit cost ratio is a method used for the initial stage of investment and planning evaluation as an additional analysis of the validation of the evaluation results. And here is the formula of benefit cost ratio. After doing the calculation above, the benefit cost ratio has two criteria. The following are the criteria for benefit cost ratio as follows. Here is the second quiz. Benefit cost ratio is a method used for the initial stage of investment planning evaluation as an additional analysis of the validation of the evaluation results. Set by who and what year? Thank you for your attention. See you next time.